One of the major lessons from the behavioural science literature and how people manage their money is that people are hugely underinsured against future problems that might occur to them. And it's not just that people have too little insurance, it's that they actually insure the wrong stuff. So let me ask you this. How many of you have insurance against your mobile phone being damaged? Or against your laptop? Or against some other kind of consumer good at home? Lots of people take out these kinds of insurance policies. Partly because they're very profitable for companies and they try hard to sell them to you. But let me ask you another question. How many of you have insurance against loss of income, against unemployment, or against mortgage default? Many fewer people have those kinds of insurance products. And so part of the reason that is that we're not very good at predicting the likelihood of bad events happening to us. Partly because we're just over-optimistic, that we think the world's kind of rosier than it is. But also because we seem to have a particular problem about compounding those small events and figuring out how likely a single bad event is to happen to us. So think about it like this, that even though it's unlikely that you're going to fall down the stairs and break your leg, that you're going to lose your job through some kind of accident at work or otherwise, or that there's going to be some kind of natural disaster, even if those things are all really rare, the likelihood of one of those bad things happening is relatively high. And the problem is that when people fall into financial distress and ruin, it's often not because they've made big problems over time. It's not because people are terrible at budgeting or because they always overspend. It's often down to these kind of shocks. That a shock occurs to someone's life, something totally unexpected, and that then causes a series of events that leads to these bad outcomes. So, you have a shock by becoming unemployed, and then from that, you seek emergency credit to kind of manage your funds, say a payday loan with a very high interest rate, and then over time, things spiral out of control from there. And the way that people could avoid that is by either having some kind of savings buffer that would help them kind of get over those shocks, or by having proper insurance in place to stop those shocks having those negative outcomes to begin with. And so I think that partly we need to recognize how bad we are at predicting these future bad events and how they compound with each other to mean that a bad event might be likely to happen even if lots of them are rare. And secondly, we also need to think about what kinds of insurance or savings buffers we might need in order to deal with those kind of shocks.